We need to see some combination of these four things. I'd say the first one is some deal on tariffs with China.
Okay.
That's the one that matters.
All right, check.
Okay. Number two, dovish Fed.
Okay.
Where they kind of get off the stick. Okay. Number three, we see rates come down in a more meaningful way, the back end of the market, without growth really deteriorating. Okay, and then the fourth one, which is probably the most important for stocks, is earnings revisions. The wild card now is, are we going to have a recession? Okay, and I think, our economists would say it's a coin toss. It's a 50-50. If you don't get a recession, the lows are in, okay, for the year. If we get a recession, you probably got to do a full retest, maybe a slight break, okay, and that would be a labor cycle. That's the only way to define a recession. It's a labor cycle. All this stuff about negative GDP, I don't care about that.
All righty, how's everybody doing? We're going to do a little market analysis. It's been a while. We haven't been live, but I wanted to do, a little catch up. It's been a while. There's a lot going on. This has probably been the craziest, unpredictable, I don't want to say market, but just understanding how to analyze the macro and the technicals, more so the macro than ever. Let me know if the audio is working. We haven't done this loud and clear. All right, perfect. Okay, so yeah, we're going to go through a couple things. Keep it simple, right? There's a lot of confusing stuff out there. So let's go ahead and keep it simple here. Starting with the S&P 500, kind of the market, we'll go over the economy. The most important thing here is a trade deal, right? The market needs a trade deal. Now, you saw this gigantic capitulation. If you're not familiar with that, if you're newer, not used to technicals, this big tail just basically means buyer stepped in, the hedging came off, and the bulls really stepped in. And nice, it hit the anchored VWAP from the recession from the 2022 lows, right? So volume weighted average tells you there was enough. That was a level where longs wanted to get in, where shorts basically covered, and most of that was just driven by the fact that this was a complete panic, right? Complete panic, and the fact that we have that tail, and this is a bullish price action. If you don't believe in price, well, guess what? Only price pays, right? At the end of the day, only price pays, not fundamentals. In the long term, they do, but only price pays in the short term. In the long term, we expect this to, turn into something constructive for the next 5 years, right? 3 years, whatever it is. So you have this reversal pattern. This is a reversal pattern. We're starting to get bulled up here now that we've, basically cross the God candle. But the most important thing here is this gigantic capitulation is super bullish. Wanted to point that out. That means there's not, the investors, retail's buying this up, by the way, from what I've seen. Retail traders or investors are buying this up, mostly millennials. They're not panicking. They're younger crowd, right? 401ks, whatever it is, they're on Robinhood. And this tells you that there's an underlying bid in the market. There is a bid in the market. You really need things to go sideways for us to roll over and make new lows, which would be an all-out recession, sort of how Morgan Stanley, Mike Wilson was talking about, right? You need an all-out recession. So number one, we need a trade deal, or we need visibility, to get back to all-time highs. Let's go into the weekly chart. Let's look at the weekly here. Look at a little more technicals. Oh, I got a lot of stuff marked up there. But you can see momentum is picking up. We're going to go over the, the economy. Momentum is picking up. We're not out of the clear, but the fact that the RSI is just, went vertical, this was a signal to buy, not just buy, but the market would reverse. We're oversold. We're halfway. We're at the halfway mark. It's critical that the market sentiment and positioning starts to be, gets more comfortable with the market. Investors need to get more comfortable. Hedge funds need to get a little more comfortable at these levels. Why would they? It all depends on the damn trade deal, right? We need that first and foremost with China. There's headlines here, there's headlines there. Next is going to be after that deal with China. So we do have the momentum picking up. The market is, in a bullish, we're showing some bullish technicals. I mean, that is beautiful. If you're not used to it, that is a beautiful technical view. I think we'll do a little more technicals after we talk. We're breaking that trend. Okay, so we are breaking the trend. This is good. This is very constructive. And more than anything, the market is pricing in, we are pricing in a potential trade deal with China, right? And what does that mean? That could be so many different things, but the market just wants relief that, hey, we're not doing 150% tariffs, not destroying the global economy. You can invest XYZ, but there's still issues ahead that we need to talk about, right? There's still some problems that we are going to see. The economy without the trade deal. This is tricky because there is no macro point. There is no data point that really tells you what's going on. It all comes down to what is Trump going to do next, right? How is he going to react? The rest of the world does not want tariffs. They don't want to deal with that. So it's really in Trump's hands to F it up. And I was worried he would do too much, and he did at first, right? So you need a trade deal. The market is pricing in the trade deal. We're looking good here. Momentum is rising. Look at that momentum. It is rising. Bitcoin's headed for 100,000. We'll go over Bitcoin technicals because Bitcoin is getting to the point where there is no supply. Demand is accelerating. It's a lot like gold, and there is no coming back. It just completely, takes off. So we need a dovish Fed, and this is where we're going to turn to the data here. We do need a dovish Fed. I believe we have a Fed meeting coming up. Let's go ahead and check the calendar here. This is more like a mini podcast, right? Let's check the calendar together. This is like a mini podcast because the videos take a lot of editing and just trying to catch you up, analyze the market. Let's go ahead and switch this over. We're going to switch to the data. So, technically we are looking good. Let's see if I remember how to switch the screens here. There we go. Let's go to the data and we're going to look at breadth also. Give me the option. Where's my option at? There we go. We're going to look at breadth too, which is how many stocks are, participating. We're going to go through all those technicals. I like to call that price, right? You have price, which we will go over. It's, that's the funnest part. You have the environment, and we're going to go over the environment right now. And you have the potential. What is the potential? The potential, everybody knows the US has the best, market by far. Bitcoin, crypto, I think has most potential other than robotics. We can hit that too. This is going to be longer than I thought if we do. And, AI, obviously everybody knows that. But the environment is the most important thing right now, the macro. And here's what we're seeing, right? This is, go to tradingeconomics.com. I'm going to give you as much value as possible if you want to track this. Now, how do you know how to read it? Just look at the red. Those are the highlights. That's kind of what we're talking about here. So far we had this GDP. Let's go over GDP really quick. It's negative, right? Negative 0.3. And I'm going to break it down really quickly. That's bull S, right? Bull crap. It's not that important simply because this is the subtraction. What up, Draveen? Okay. Yeah. We'll catch you later. Basically, that negative GDP is literally just imports. Imports are, the US companies, whoever buying overseas, investing overseas. And because that's spent elsewhere, it's a negative. It counts against GDP. But really all that was inventory coming in and resold in the US for spending. So it's kind of stupid. You take out the imports, we're still positive, right? Consumer consumption for the consumer is up. Business investment was strong. You saw Meta's CapEx is expanding. I think Microsoft's is staying the same. So we're pretty good there. Anyways, GDP, don't worry about that. GDP is not turning really negative. We're not in a technical, you can say it's a technical recession, but a lot of times the data is, you see new things in the market, and the market would not be going up right now if we're really in recession, but we are headed there if the employment doesn't hold up. If employment doesn't hold up. So next part here is the ISMs, because we're talking about a dovish Fed, right? We need a dovish Fed. What do they want to see? The Fed really wants to see, and we'll just jump forward. They want to see two things, either inflation, and we had these data points this week, PCE. They either want to see inflation drop to a very specific level. Let's go core. The Fed is always talking about core PCE. And you can go over the month over month, right? That's the short-term data, which gives you these small bursts of what's happening now, but we really want to see the trend because we're trying to predict the future, right? So in the short term, we had 0% inflation for the, Fed's inflation. We have another inflation print in a couple of weeks, but we had 0%. And that's great. I don't know why people are saying, let's go ahead and demystify this. Because I saw some people say, oh, inflation was high. That was quarter over quarter inflation. This is PC quarter over quarter. It jumped up, but this is a midstream measurement, meaning it's not measuring. There's all these different measurements, and this is quarter to quarter, which is literally just those imports, right? A lot of it is the imports. It's not real core inflation rising. Because if we look at you saw the short-term trend, we're at 0. You go over the long-term trend, core PC right here, core PC down here. This one's not highlighted red for some reason. core PCE. This is the beautiful one, right? Big drop, 3 to 2.6. This is what the Fed is focused on more than anything. When they talk in their meetings, they're looking at 2% core PCE. Where are we at right now? We're at 2. They're looking at 2. We're at 2.6. So I believe this is this is kind of the bottom, not the lowest reading, but it's pretty low, right? We're looking for 2%, but that's not today. That's not 2 cut rates. That 2% that they're looking for is over the next 2 years, I believe. And, you could check me if I'm wrong. I believe that's into 2026 or 2027 that they expected to hit 2%. So this doesn't mean tomorrow. They can still cut. The issue is when it comes to a dovish Fed is their tone. What do they say about this? Inflation is coming down, right? The economy is slowing in certain segments. It's a rolling recession. What up, underground economist? We need BTC to jump, rip, blah, blah. We'll talk about BTC like a double overnight. Yeah, I know you're bullish on BTC. It's looking very bullish, and we're going to get to that. We just want to lay over, kind of give you, what's going on with the economy. Number one, Trump has to make a deal soon. The longer he delays, the more treacherous the recession comes, right? Simply because businesses, and we're going to go to the ISM. This is basically business activity. We're looking at ISM manufacturing because this represents the cycles, right? See these cycles, how we go up and down? That's basically the momentum of the, the cyclical economy. And you can say, oh, well, services are pretty strong. They are strong. But when it comes to financing for markets, when it comes to financing growth, manufacturing is where most of the financing is, right? For example, in simple terms, if you're doing a service like you're selling coffee, you're mostly not financing the coffee, you're financing the building, right? So to run your businesses, they don't have to be brick and mortar, but you need something that is going to be, you're going to be borrowing money. And that manufacturing cycle basically is the frame. I don't want to say the framework, but it tracks, the beginning stages of business growth. Not really, not necessarily, profits or margins, but you need these financing cycles. And you can see we're stuck here. We bottomed back in 2023, but we're stuck here. So in the short term, let's go ahead and dial down. This is important, the ISM. And it has some flaws. We're going to talk about the flaws. The ISM, you can see for the last 3 months, 1, 2, 3, business confidence is falling again. After it jumped with Trump, business confidence is now coming back down because it's uncertainty, right? Trump's style is, hey, I'm not going to tell you what we're doing. He's running a business, a real estate business, but markets are so fast. Information is so quick. You can't really be successful keeping the market unaware of your plans. You just can't be that successful. You have to make all these promises, which is why now he's switching over saying, hey, we're going to make the biggest tax cuts of all time. And I'm going to keep it clear. I'm a Trump fan, but I don't agree with everything. I don't want to say everything, but I notice his mistakes. I'm like, bro, come on, bro. Like, hopefully net positive for the market, for the economy, socially, I'm all with it. But you cannot be too risky with markets. You can cause a collapse in sentiment because a lot of small businesses, right? If they don't know what's coming next, they have to hunker down. They can't guess. Nobody's going to sacrifice their future just because they're going to say, well, tariffs won't be here. We'll just trust it. Heck no. If their prices double, they're out of business. Their families are done, right? They got to go work somewhere else. That's not something you want to mess with. So this is sentiment. Here's the thing with the ISM. It does track the cycles. It's basically confidence in these, it's confidence in the manufacturing sector of the economy, which is the cyclical part, which is what the Fed is also looking at. Confidence is coming back down and it'll come right back up. So usually a recession is like 47, right? Under 50 means you're negative. Confidence is falling. We're under 50. We haven't been above 50 since, for a while. We haven't really stuck around 50. We keep hitting it, coming down, hitting it, coming down. But we need positivity. We need visibility on the damn trade deals. We need to know exactly if businesses can see, hey, oh, our prices are going to go up by 10%. They can now adjust to that. If they can't adjust, then they're going to be very uncertain, right? They're not going to know how to budget for the next month or for the next 3 months. So there's, businesses are struggling with the ISM there. Now, when it comes to the Fed, again, we want a dovish Fed. The Fed is in the same boat. The Fed cannot really, and I don't think they cut. I'm just going to keep it real. They're not cutting in May. Really quick, when is their meeting? Does anybody know in the comments when their meeting is? I thought it was mid-month, and then I heard something about next week. Is it really next week? And we'll come back to the ISM. Hold on. This month. Let's go next week really quick. You know, this is how you navigate this. See when the Fed, okay, it is. Okay, it's the 7th. This is a little earlier meeting. No wonder. So the market is running up right now, but guess what? It's positive news for the next 3 months, but it's not necessarily meaning we're going back to all-time highs. You need the Fed to be dovish, aka in simple terms, they need to say we're on the side of easing financial conditions, we're on the side of lowering rates, right? Basically, you want to hear them say that inflation is going to be transitory, meaning we can see through the tariff hikes. We can see through it. You want the Fed to say we can see through it. However they decide to say it, we don't know how they're going to say it, but if they're hawkish, they're going to say something like, things are uncertain, so we're going to stay tight. Inflation is a big concern. It's hard to decipher that because it's really their tone. It's more artful than mathematical, but at the end of the day, as long as they communicate to the market, because they're already cutting QT, which means they're not removing liquidity from the market as rapidly as they were before. They pretty much stopped it. That's pretty dovish, right? That's what got the market going, I believe, or is one factor keeping the market strong, is liquidity. They're not hitting you as hard as they were, right? They were removing a lot of liquidity. Now they're not. And we also have another liquidity, another thing on liquidity. The Treasury sent out their schedule a couple days ago on Treasury buybacks, meaning they're injecting liquidity into the Treasury market and the bond market to artificially, lower rates. That's another variable for the upside, right? Anyways, Fed rate decision is on Wednesday. I'm going to try to stream that. I think I'll do it. I need to. Okay. I need to stream it because this is going to be important. But the point is, the Fed needs to be dovish. They're not going to cut on, Wednesday. They're not going to cut Wednesday. That'd be crazy. But they need to communicate we're closer to cuts. Best case, they say we're close to cutting because, not because the economy is falling apart, but we're close to cutting, maybe June, because we see through these price hikes on tariffs. That's where I'm nervous. I'm not sure because there's no deal yet. There is no visibility. I think the Fed might still pause a little longer on cuts, meaning not literally the cut, but they might push it till July, or not push it. They might push the expectation till July. Right. And if they do that, the market might get nervous for a second, but there's so many variables going on. The real threat here isn't necessarily do they push rate cuts out. The threat is why, right? Today we had a labor market report. Let's go ahead and hit that because we're talking about the Fed cutting, right? That's the most important thing, is that they're dovish, that they support. Markets are looking at 2026 now. They're already looking a year ahead, and they're just saying, well, where's the Fed going to be there? Where's inflation going to be then, right? So let's go back to this week. Podcast style here. So looking at this week, right? Yeah, GDP is negative. That's all imports. Market looks through it, right? Core PC lower month over month, 0 positive, right? PC year over year, that's Fed inflation, 2 point. Oh, you know what? And it's crazy. We're at 2. Look at this. When you take out, if you don't even count core, energy prices falling right now, oil is really helping out the market. This is why I'm still constructive. I don't think we're headed into some, strong. I don't think the Fed will stay. We'll pause for too long because energy is plummeting, and eventually that's going to lower the price of everything, right? Anyways, back to it. This was important. Now I think from what I've seen over the past, year or whatever, I think the employment report is literally, I've underestimated over the years. This might be the most important report to the market. And I always wondered why, it's inflation. But the truth is, and we'll start with non-farm payrolls. The truth is that, the more people employed, private employment, whatever it is, guess what? They have a 401k. They're automatically investing in the market on a monthly basis. So the market has an automatic bid in it, no matter what. Even if it draws down, at least there's some upside pressure, right? But if jobs disappear, not only does spending start to slow down and, right, the economy falters, but you don't have that investment anymore. So the jobs employment probably is the most critical component to the economy, other than productivity, which is going to be technology, and good policy, right? But you really need this to stick in here. And so far it is. And Trump is hilarious, right? because, and he's funny, we just got to talk about it. He said this is the Trump economy back when he won, right? Whenever things were good, this is the Trump market. And now he's saying this is the Biden market. I thought that was hilarious. He is the funniest president of all time, most entertaining by far. People are into politics now. They're not bored because of Trump, right? And I think that's a good thing over time because people are paying attention, young people, to the economy. They're paying attention to politics because that impacts your life, that they're paying attention to markets. Okay. So anyways, point being, the labor market remains strong. Anything over 100,000 jobs is a strong economy. Those aren't disappearing tomorrow. Just because Amazon lays off, just because blah, blah, blah lays off. No, it's construction. It is, our house is being built. Our, right? Are small businesses okay? Are people hiring? I think 99% of businesses are small businesses. So you need small business confidence. Either way, the economy remains strong. This is why the Fed won't cut in May. I'm sorry. In May, next Wednesday. And this is also why they might communicate delaying cuts all the way till July, unless inflation collapses. But the only way, and this always comes back to Trump's deal, the only way inflation expectations collapse for the Fed is if the tariffs are completely removed, because then there isn't the alarm in the back of your head that prices are going to spike for a couple months. They already did last month because of the imports, right? Everybody was hoarding inventory because they don't want to deal with the high tariffs. So they're hoarding all this inventory, which artificially, it's not structurally, but it artificially pumps GDP and, productivity, or not productivity. It pumps in business investment, right? So it's kind of tricky there, but it also keeps the economy strong because you're buying more, right? And now you have all this inventory. So the question is, are they going to slow on that? So jobs are strong. Unemployment rate is kind of weird. It jumped, it came down. We can't, the old ways of looking at the economy are no longer working, right? The SOM rule, unemployment goes up really quick and then it comes back down. The SOM rule didn't even matter. We're still at 4.2, right? Because the economy is, it is evolving from year to year. Technology is taking over more. Policies are different. This is so different. So you have to adjust, not let your biases take too much, be able to adjust whatever it is, right? So unemployment's not budging and everybody says 4.2 climbing. Trump is calling for rate cuts because that's going to help with the economy. Now, do I think inflation is a big concern? Not necessarily. I don't think it's the biggest concern. But the Fed can't make a mistake, right? They just can't, because I think the Fed is like, we're not cutting yet because we'll let something collapse in a business and then we'll come in and we will inject liquidity into that market. And if it's a bank, whatever it is, it's probably going to be real estate, honestly. We can come back, inject liquidity and keep things on the surface. But if we cut rates, people are going to start borrowing. They're going to go on margin and inflation might be stickier than it should be. So it's a waiting game for the Fed. And of course, Trump wants rate cuts. Who knows if it's the right thing right away? They're not going to cut yet. Okay. Employment is still low. Historically, look, check this out. Historically, this is in one of the courses. I'm going to bring I made some courses. I'm going to bring the price down on those courses, right? I'm going to bring that down. I haven't decided yet, but it's a macro course introductory to get you guys understanding. If you're new, if you think you know enough, that's fine. Anyways, historic unemployment is around 5%, right? The median. Therefore, we're still historically low. The Fed has no reason to cut unless inflation collapses. And our best guess for inflation collapsing is going to be oil coming down, right? ISM, here's a problem. You go back to ISM. Remember we talked about business confidence? Let's go ahead and go back to that. Business confidence coming down. This is the negative part of the economy. It's coming down, right? Oh, we don't know what's going to happen next. A lot of uncertainty, but the prices within the supply chain are still elevated. This is what the Fed needs to see come down. This is what markets need to come down for us to get back to all-time highs or have the sentiment where people really get bullish. What if Trump doesn't want a deal? He wants a deal. He has Scott Bessent. He has some other people around him. Believe it or not, Trump he wants all the credit. You feel like he wants all the credit, but he's not stupid. He's not going to allow the economy to collapse. That's why he pivoted April, whatever it was, when the bond market almost literally rolled over because interest rates went up tremendously overnight. long-term rates, and he pivoted. So Scott Besson is the genius there when he's the one negotiating with China right now. So does he not want a deal? You know, there's just put it this way. There's so many ways to make a deal. This is why it's so uncertain. You know, you have all these products, you have all these goods, you have all these services, you have all these supply chains, you have different levels of tariffs you can hit. So the question is, it's impossible to calculate it because there's too many variables. The question is Trump going to de-escalate tariffs, bring them down slowly? If so, that's a bid in the market, right? Because we already have tax cuts coming. We have, biggest tax cuts in history, according to him. We have the Fed cutting at some point this year. The question is, how does he de-escalate the tariffs? And, you know, is he going to cause, because right now for economy is okay, right? In the short term, certain segments of it, but the market's going to freak out if there's an escalation against China. Like, oh, no, we don't agree on that. We just need things to calm down for markets, right? Why? Because the bond market, not necessarily stocks, but the bond market is the thing that is controlling the interest rates. If the bond market freaks out and continues to climb, which is the next, the next thing on the list for markets to recover is going to be rates on the long end coming down, right? And that's going to be based off of the confidence that tariffs will not escalate, right? That's what we need. Tariffs will not escalate. So before we get ahead of ourselves, I'm going to come right back out of the macro or out of the data. We're going to go back to the charts here and, make sure we cover everything. Let me switch this up. Any questions? What if Trump doesn't? Let me switch back over because I want to go over the technicals of the market. I want to go over the breadth and kind of see what are people doing, not just what is the macro, but to sum it all up, when you look at the macro, growth is a bunch of different things. Consumers are still spending. Okay. You hear negative reports, consumer debt this, consumer debt that. Well, it's a mixture of uncertainty and it's a mixture of, there's still enough jobs, obviously. It's a mixture of uncertainty that things are slowing and just the part of the cycle, right? When I say part of the cycle, well, long-term rates are just too high. Let's check out long-term rates real quick. This is what's kind of keeping, I don't want to say all consumers, but a lot of consumers is that, these rates go up and down 4 or 5. I mean, we look at this jump. Okay. If you're a homeowner or you're looking to buy a home or, that's going to really determine where rates are is really going to determine your moves. You might be saving money. You might say, damn it, I have to get an apartment, right? These are contracts, long-term contracts, and part of the business cycle. So rates came down to 3.8. Trump was happy, right? The market was like freaking out, but it was like, okay, rates are down. Fed's going to cut. And then, then we got an escalation between China and Europe. Boom, they popped. That's where I kind of freaked out. I ain't gonna lie, I panicked. I was like, son of a gun. We're going to be here for another 6 to 12 months. And then quickly Trump pivoted. They came back down, right? So we need Trump to continue to de-escalate, and that will get rates down because the economy is already slowing and rates follow inflation first and then the economy. So as long as inflation continues to come down, which is why we've had this, nice move lower, other than the de-escalation, real inflation is coming down, but we don't want them back at 4 or 5. We really want rates between 4, right? And we don't know. I don't really know exactly, but I'm going to guess somewhere between 4 and 4.2 for now, right? For now. Do I really know? No, I don't think anybody does because then it'd be impossible. All I know is the market freaks out when rates start to press against 5. The market freaks out. Below 4.2, the market is like, okay, well, is it a concern of growth or inflation? Key, we just need inflation lower. We need people to slow down on their spending, save a little more, right? Is that going to slow down businesses and demand? Yes, it will, but it'll get the Fed to cut, right? And it'll get, energy prices already coming down. So before we get too wordy here, we need a trade deal, right? We need visibility on the trade deal. Let's go back to SPX. We need a dovish Fed. How do they get dovish? Trump continues to de-escalate. Maybe you get a deal with China over the weekend. You never know. And then we need long rates to come down. And why are they going to come down? Well, they're going to come down when they believe that tariffs are, inflation is coming down, but long rates are tricky. The bond market is tricky. I think it's going to be harder to see that. They've done the opposite of what I've been so wrong on rates. So wrong. I thought they were coming down and they come up. I'm like, bro, what the hell is going on here? So, but here's the thing: you do have the U.S. Treasury buying treasuries, right? So is this the thing? No, this is not it. They released their schedule. Do I have it up? Let me see if I have it up. I don't think I have it up, but they did release their schedule. It's on my Twitter, and they are buying back treasuries. It's not a huge bid, but they're basically gonna artificially suppress rates. And then when you get the Fed kick in and start doing it, right? Let's go Wall Clave. Let's go. If you're on TradingView, WALCL, this is the Fed's balance sheet. This is really what suppresses rates when it goes up. When it goes, oh wait, can you see that? Yeah, you guys should be able to see that. When this goes up, meaning they start QE, then they are now buying treasuries, which suppresses rates. That is the most important thing that the market wants to see. But inflation, the Fed's like, we're not going to let inflation stick at this level. So we need to let things be a little more, we need things to slow down a little more without breaking too much. Now that the Treasury is buying back treasuries, that suppresses rates, long-term rates, mortgage rates come down, people start buying houses again, home builders pick up, construction workers come in, employment picks up. So the rates really matter the most, and nobody can predict it. I heard a lot of the bond vigilantes are conservatives, which is very interesting. And anyways, that's beside the point. You need the Fed's balance sheet to come up, right, at some point, or flatten out, or stop selling treasuries into the market because there's not enough buyers at the moment. So they need to stop selling these treasuries. I'm probably losing people because this is, a little more complex. Point being, well, here's the other factor. We do have liquidity picking up. So our last thing is earnings revisions, right? Let's go back to the S&P. Earning revisions need to bottom, and that's all depending on the trade deal or the de-escalation. I don't want to say a trade deal because there could be 1,000 deals, but it all depends on the de-escalation, because if companies can see, oh, okay, now we know which part of our supply chain or our inventory is going to be more expensive across seas, or once they start to reestablish, okay, we're, Apple's reestablishing a lot of their iPhone stuff, build in India now. So once there's clarity, then the market can have certainty. Okay, we can calculate this in. So earnings revisions need to bottom out. And I don't know where they are right now. They're kind of falling, they're kind of stopping, but they need to slow down. There's so many different, earnings revision, documents you can look at, but it changes based on what Trump does. So I'm just like, okay, there's no reason to really go look and say, oh, earnings revision stopped. Because if he doesn't make a deal, they keep going down. If he makes a deal with India, China, Vietnam, whoever it is, earnings revisions can slow down. They can bottom out. And then the market can come up. Now, our next month earnings going to be worse, our next quarter, probably for a lot of firms. But the market bounces. Keep this in mind. This is important. Let me tell you guys. And I've learned this over the years. If I had the chart, I'd throw it up. The market bottomed 6 to 9 months before earnings bottomed. 6 to 9 months before earnings bottom. The markets care about what's happening over the next 6 to 12 months, not necessarily today, right? That's why we have this capitulation where we priced in a collapse. Why does it look like that? Where's the rest of the chart? Oh, it's not even SPY. Where we priced in this big collapse, and now we're back up in the month of April. How crazy is that? April went negative 16 and finishes down 1%, right? So we opened here. I'm going to zoom in for you guys that are new. I'm going to zoom in here. Okay. Candlestick patterns open, red candlestick patterns open at the top and they close at the bottom. So we opened at 56 and then we closed not even 1%. I thought it was 1%, maybe less than 1%. Either way, we dropped all the way down 16%, pricing in recession, pricing in Armageddon, and then we came right back up. Very bullish. It's good. Can we go back down? Sure, we can roll over. But that's why we need the Fed to be dovish next Wednesday. What gets the Fed dovish? They see through. How do you track that? They got to see through inflation. Yes, the deal could happen this weekend. It could happen. We don't know. That's why it's so uncertain. We just don't know. Now, what we're going to do when it comes to earning revisions, okay, let me switch charts here. When it comes to earnings revisions, here's one way to track that. A lot of earnings are actually ISM, right? Supply chain management confidence, because the more confident they are, is this the chart? The more confident they are, and I'm going to keep it simple. Just get all this stuff out. The more confident they are, the more they start to invest in inventories. Why does that matter? That's because it's earnings. Take off TLT. We don't need to see TLT. And yeah, I wouldn't trust TLT right now. So many times I thought I was going to be long bonds and I just didn't work. Why is this not working, bro? Stuff pisses me off. Just freaking bugs on top of bugs sometimes. No, why can't I click the 3 dots? Damn, stuff pisses me off. It just doesn't work. I'm trying to hide it because it's not what I want to see right now. I'll just turn it into a line. Those are just bonds. Anyway, so these are, where's the ISM at? Non-manufacturing. Here we go. US non-manufacturing. This should be business act non-manufacturing prices. No, that's prices. Because we're getting ISM services next week also. New orders. Well, I guess we could look at the new orders on both sides. Okay, we can do that. So you can see here, this is the recession part. Now, what are these? Red is this. There's 2 parts of the economy. There's services and there's manufacturing. These are the orders, which are the most forward-looking. These are basically, if you take all the supply chains, all the businesses, right? So service, manufacturing, and you ask the managers, are you looking to increase your orders for next month or decrease your orders? Well, you can see that orders in red, those are services, are coming down. They're not in recession territory, which is kind of a, not really the best term in these circumstances because there's a disruption in the business cycle, which is trade policy and uncertainty. It's not a normal business cycle because there's changes in policy, right? If it was flat, we would say, oh, we're heading into recession. But the truth is, this all comes down to the confidence of these managers. And they're saying, hey, look, we're just going to say less orders because we don't know what the hell is happening. Same thing for manufacturing. This green one, it's lower. So this is why earnings revisions are coming down, because if there's less ordering, you're going to have less revenue. There's less you're selling. There's just not enough demand out there, and companies are not ordering. So once these turn around, the new orders at least, and I think this is lagging. This one might be lagging, but once the new orders turn around, earnings revisions will be clearly bottoming. Now, if we go to prices, you can see prices are spiking. That's the cost of business is too high, hurts margins, right? You don't want to see that. That's and I know these are nerdy, the ISMs, but they're very important. You know what? This one's not giving me what I want though. But here's services we're gonna get next week. This one has been positive. It never really went into recession. This has been holding up. I want to see the confidence in certain investment opportunities. Actually, that's a stupid big word. The service part of the economy still has a lot of activity. So with employment numbers this Friday, literally today, being as high as they are, well, those are in services. A lot of the services. I haven't done a deep dive in which, exactly which part. I really don't care because I'm looking at Bitcoin. I'm looking at, the overall market, tech, call options. I don't care exactly what industry it is. I just want the market to deploy more capital in my investments. Doesn't mean, I don't care because I'm not running a business in that certain area. So services are still positive. 55 is good. Anything above 50 is positive, right? Now you can see it's very cyclical, but it's not that cyclical. Actually, damn it, this chart sucks. It's not as cyclical as manufacturing. So the real beast here is going to be ISM manufacturing. Here it is. Okay. This is the one we want to see go up. When this goes up, you see we've been in recession. We've been coming in, going out, coming in, going out. Once we turn up here, Bitcoin launches. Do I know that for a fact? No, I do not. But that's been the historical cycle. This is the real cyclical economy. Up, down, right? Now, that doesn't mean that the entire sector of the stock market goes up and down according to this. This is more so companies that rely on financing or businesses that rely on, financing growth. Why is that? Because the more that manufacturing goes up, the more that's the base layer of the economy being built, right? If you're like, hey, you know what? I'm going to build a coffee shop. Well, is it a service? Yes, coffee is a service. It's a good, you're running a service, but you have to buy a bunch of goods. You have to get a building, You have to get inventory, right? So that comes down to the ISM at the end of the day. That's why yes, it's not, services are 70% of the economy, but you need the manufacturing cycle to go up to really get bullish, right? It came up for a while. That's when Trump first came. We were rolling. Look at January. That's when stocks were ripping. Boom, came right back down. So we need this to go up, and keep your eye on that. Whatever. I'm not going to. Point is, we want to see the ISM go up, right? Now let's move on. I'm spending too much time on this. Earnings revisions go up when the ISMs start to pick back up. Just keep it that way. When the ISMs go up, earnings revisions can start to bottom out. We can see that in the confidence of the damn supply chain managers, okay? Now growth, rates coming down without growth. We need inflation down. This one's also good. Here's the other key. I'm getting nerdy here, but here's the other key. Inflation is falling. Do not be fooled, okay? Inflation is coming down. Where's my inflation indicators? Oh, and here's the confidence. Check it. See how consumer confidence is trash? Business confidence is now rolling over. You have an opportunity here. The opportunity is it justified? Is it justified? No, because the Fed is not tightening, right? The Fed is easing. So this is not justified. This is more so, this is how I feel. I don't like it, but it doesn't tell you what's happening over the next 6 months. That's the ISMs. That's actual business activity. Okay, so inflation, I wanted to show you this. This is PPI, producer prices. Yes, they're trending up, but oil prices coming down is basically going to take that out. And then you have here, this is, what do we got here? We got annual change of core PC. This is what the Fed's looking at, okay? Core PC, you can see that's cooling down. We have the inflation. Is this inflation rate? Yeah, this is the inflation rate, which everybody focuses on usually. Let me take these off. The inflation rate is falling. This includes oil and food. So Trump did one good thing. Oil prices, energy prices are lower, and food is lower. Okay, food is also lower. Not all around. You guys get upset. Oh, my hamburgers or my hot dogs, whatever. Eggs came down. Point is, who cares? If we're talking markets here, maybe some of you guys do care about your food prices because I do. They're expensive. But my point is, when the market sees, okay, we have CPI coming back into the normative range, right? Around 2.5. You don't need to go to 2% to get a bid. You just need it to continue to roll over. And shelter's really rolling over. That's the good part. Shelter price here in Phoenix, inventory spiking. If you think about moving, maybe over the next 6 months, housing in Phoenix is really rolling over. So keep your eye on that. Not like 2008 recession style, but you don't really get dips in home prices very often. So CPI is coming down. We've seen all these inflation indicators coming down, right? Now I'm going to kind of switch it up again, go back to growth. I just showed you, CPI. Let's look at this. This is retail sales. Very positive here, okay? This is in my course, which I'm going to bring the price down. Just go check it out. I'm bringing those prices down, okay? And I'm not a marketer. I'm not really good at sales or anything. So I'm just saying there's a lot of information. You go through it, takes a quiz, and it brings you up to date. Okay, now I know what I'm looking for when it comes to the data. Now I know what's important when I don't know what's important. Let me ask you guys this. Would you pay for a course that educated you for $10 that comes with a monthly subscription for my email, my thoughts? They're my personal notes on the market. Maybe more than 2 times a week. Obviously, every other day I'm probably posting what I see happening just to keep you in the nerdiness of the macro economy, right? Would you pay $10 for that? That's all I'm asking. Okay. I had it a lot higher, but I realized, you know what? We're heading to, no, I'm just kidding. I realized that I want to give you guys a good deal, a better deal than it's worth. That's what it should be. That's what it really should be. I'm not trying to scam anyone here. So retail sales are probably the most beautiful, okay? Probably the most beautiful metric when it comes to what the hell is a consumer actually doing. Retail sales are climbing. This is why also the Fed is not cutting, because you see, growth is up. Now look at retail sales climbing. Just boom, 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 bro. Boom. Yeah, Tanner, maybe I should say 1999, right? I don't know yet. I just don't want to make it too expensive. So retail sales are up. That's very positive. This is why I'm still constructive on the market. We're not headed into recession, guys. Can we? Yes, but we're not there yet. We're not there yet. And I know a lot of analysts are like, oh, recession for sure. We're heading into recession. Well, the only way you really get recession in the past is when oil prices spiked, because that's energy is the most important factor when it comes to running your life, right? Your energy bill, your gasoline bill, your traveling bill, right? Traveling bill, airline, whatever. Energy is important. So with lower energy prices, we're not headed for recession. The Fed will always step in, either cut a little bit of rates or increase liquidity, but you're not going to get a recession, especially with the consumer really doing this. Now, with the tariffs with China, yes, you get a recession if there is no deal. That's why everything comes down to when is Trump made a deal. It's impossible to predict because some of the deals are exaggerated. Oh, yeah, deal with China on soybeans. Nobody cares. We want a deal. We don't even, to be honest with you, I don't even know. I don't know what the best deal would be with China. I don't think none of us really know. We just want to see progress, negotiations taking place. Why? Because there's too many details on the deals, right? There's too many details. But what we know for sure is that we want a good deal, and Trump is going to get a good deal regardless. He's going to get a good deal. That's one thing he's good at, right? He's good at bullshitting and he's good at making deals. So retail sales climbing, industrial production. This is the real. When I look at retail sales, those are consumer spending. When we look at industrial production, this is the actual production part of the economy. This is also in the course explaining this, right? Production part of the economy. So meaning even if the ISM is trash, right? The ISM is printing new orders in recession territory. What really matters, and I learned this the hard way in 2023 when I was like, ISMs are, low. Why is the market still going up? And I learned from Neil Dutta, one of these, anyway, you don't care. Industrial production is a hard reading. It's hard data. It's real data. It's what's actually being produced, where the ISM is the sentiment of the future. So ISM can predict the future, but also it's like psychology, where if you believe something bad's going to happen, the ISM is going to show negativity, where industrial production, it doesn't matter. If you think something bad's going to happen, the industrial production depends on what's actually being produced. It's real math. So it's irrelevant, right? So that thing is still pretty, it's nice, right? It doesn't have it's not a high reading, but as long you see how it's turning up, maybe it makes a higher low, right? The bottom is in for sure. One positive thing about Trump's policies is there is manufacturing booming in certain areas of the US. So I think industrial production continues to ramp up. This is good. I'm not too worried about recession. I'm really not. He's going to make a deal. Scott Bessent, they're smart. The question is, what's your time frame? If you have a long time frame, you're solid. Where do you buy, right? All right. So we've talked a lot about the economy. Is there any questions on that macro stuff before we move on to so here's the thing. We need a trade deal for sure. We need the Fed to get dovish. How do they get dovish? Well, they have to look through the tariffs. How do they do that? We don't know. We're going to see on Wednesday what they say. I hope they're more dovish on liquidity. Maybe they completely stop, their buyback or not buybacks. Maybe they completely stop QT. That'll give the market a boost. It did last time. And then we need inflation to keep coming down. That is happening. Okay, that is inflation. Dude, I don't give a damn. The tariff inflation is a one-time, maybe two-time bump up in prices for companies that they try to pass all over to the consumer. What do we see? That the consumers are still spending, retail sales, right? You guys are still taking trips. Maybe you're pulling back on some things, and that's a good thing about being a human and not an animal. Is you can think, oh, how do I adjust? I don't go to the same thing, right? I'm no longer going to this nice restaurant on Fridays. You know what? I'm going to make some food. I'm going to make some healthy food also, so it's cheaper, right? You can adjust. And I think we're just going through an adjustment period as long as Trump makes the deal. If not, we're screwed. Okay, he has to make some deals here. And then earning revisions are the ISMs. We'll track that. Retail sales are up. Industrial production's up. We'll keep track of that. But it really comes down to the Fed. Now we're going to switch to technicals. Let me read some of these chats. So let me go. If you guys have any comments, throw it. Hey, look, I don't know everything. Throw me out some comments on what you think is going on also. Almost all housing markets are having issues. Oh, you know what? Let's pull up the housing. I got housing on here before we get to the technicals. Some people are like, housing. Oh my gosh. Well, you're in real estate, so you know what's up. These are all the housing market indicators. Okay. Number one. Well, I don't want to say number one, but this is, come on, what is this? So this is building permits. That's why it's at the top, because it's more forward looking, right? If businesses or real estate investors like Tanner are going out and getting permits, well, they're expecting to build, right? That's a positive. Look at the trend. Look at the trend of building permits up. That, what does that tell you? That yes, housing is pissed. It's kind of like when you buy a stock at 100 and it goes up to 50. I'm sorry, it goes up to like 120 and then it comes down to like 115, 110, and you're pissed, but you're still up. You're pissed, but you're still up, right? You're pissed because it should be booked, but you're still up. And right now, the volume of, building permits or construction, that whole threshold of real estate is still rising at a very slow pace. Okay. And not everybody, some people are completely out of water. If you bought that stock at 150, you're underwater. But my point is that the bottom of the cycle is already in, and we're starting to come up. And Trump, he slowed it down for a long-term gain. Okay. Which pissed me off because I was expecting crypto to boom. Okay. It did piss me off. I'm not going to lie. I'm not perfect. But I know what he's doing. I get it. He wants to, sometimes you have to cause some pain to really establish the roots to get to something. Okay. If you have gut issues when you turn 40, you're gonna have to go get your colon checked. Well, guess what? That means you're gonna have to stop right now eating all the trash food, which you should stop, and maybe start eating garlic, turmeric, and cut out a bunch of crap. It sucks. You feel like crap for a while, but then you come back. And why do I make that analogy? Because the truth is, if you're going to feel better in the long run, you need to reestablish the US as a manufacturing giant. Okay. Not bigger than China, never going to happen because US workers are not going to work for the low wages. They're not going to do it. But you do have to manufacture certain things here in the US. So he's reestablishing that. I'm here in Phoenix. I see semiconductor plants going up. You want a job? Come to Phoenix. I know I don't have a big crowd here, but there is jobs in Phoenix. Okay. They're not the job you probably want because everybody wants the best job that suits them. But there is Taiwan semiconductor jobs like crazy. There is teacher jobs because there's so many damn kids. It's fast growing city. It's hot as shit though. That's the only thing. But at the end of the day, it's great in the winter. Okay. I didn't even read your whole thing, Tanner. My bad. Cannot buy any. So Tanner says almost all housing markets. Hey, feel free to throw out the comments. Throw something in the comments and I'll read it. I'll read your comments. Almost all housing, can't even read, markets are having issues right now. Investors cannot buy any property right now due to lenders' requirements and high interest rates, unless interest rates come into the fives. Okay. Yeah. So a lot of issues there, which, what does that come down to? It really just comes down to visibility on the trade deals, because then the Fed can cut and then the bond market can slow down and then rates can come down. Right. And when does that happen? We just don't freaking know. We just don't know. So anyways, building permits are up. Let me speed it up here. This is the trend. This is a cycle trend. Building permits rising. That's good. Housing starts, new housing starts, right? Bipolar, up, down, up, down. So those are bipolar, new housing starts, which is kind of what you're describing there, Tanner, is you get excited, rates are down and then they come back up and then, you slow down. So it's been bipolar for the housing market. Do I need to go through every metric? Yeah, because this one looks good. This is new residential sales. So that's actually picking up. Zoom in. Look at that. See how the bottom was way back in June? We're still rising, just slow. It just sucks. Okay. It just sucks. But those are still rising. So business cycle still strong. And then we have here last. Let me calm down a little bit because I'm clicking like crazy. Here we have these are home builders, right? This is home builder sentiment. Bipolar, up, down. It's like a wedge, right? Is this a bear flag, bull flag? Well, it's not a price, it's sentiment. This is also sentiment. So what is this home build? Why does this matter? Home builder sentiment, the more positive they are, the more homes they build, the more employment it attracts. Also the more inventory, the lower the prices. Not necessarily incredibly, that all depends on rates, but home builder sentiment is huge, and it's not going up or down. It's just sticking in the middle and it's getting tighter and tighter. This comes down to the trade deal. This comes down to the Fed cut, right? Which we don't know when we're going to get it. So there's your housing market stuff. Now the exciting stuff. Okay. We're going to switch over to liquidity. Actually, we're not there yet. I'm gonna go through everything I have. I'm gonna throw it at you guys. This is like a podcast. Okay. Let's go over this one. So here we have triple B spreads. Now, to make these very clear, when you guys hear like credit risk and credit risk, right? You heard of that? I didn't know what it was. I heard about it. So, credit, these guys talk so smart, and they are, but to the average person, it's like, bro, what the fuck are you saying, man? How do I gauge that, right? So credit risk is, I'm like, what is it? for equity markets, at least for the stock market, when you think of credit risk, you're just thinking of how much liquidity, it's really liquidity, how much money, how much credit, let's use that word, how much credit is available to support business growth. That's really what it is, because the more credit there is, the more the creditors are yielding off lending their money. They're yielding, right? Just like a card. So when these credit spreads spike, what it's telling you is they're pulling back their credit. They're no longer investing. They're getting out of the yield when it comes to corporate growth, right? They're getting out of the yield. Businesses falter, small, big businesses, mostly big businesses, they start to falter because they don't have any creditors. Meaning, and I'm not the smartest, you can look this up on ChatGPT, but I'm trying to make it simple here. When this spikes, it means the confidence that businesses will not default on a massive scale is increasing. So think default risk. That's all it is. Credit spreads are default risk, right? This was 2020, boom, default risk went up, right? Business default risk. 2021, pandemic aftermath, default risk elevated, stayed elevated. You want to see that either, right? Then it came down. Now check this out. To give you an example, yen carry trade, we had a spike in the yen carry trade, but I want you to check this out because I think we're going to see this soon with the Fed. March 2023. Okay, this is important. March 2023, SVB. You guys remember the banking crisis, right? People left the bank. Basically, you had a credit crunch. Banks could not support their depositors. So the bank collapsed. The Fed stepped in, FDIC over the weekend took care of it. Well, credit risk spiked, banking crisis, and it came right back down because the Fed had stepped in with liquidity, which is why no matter what, if you're trading, I'm sorry, it's tough. It's a tough road. Most traders fail. Swing trading sucks. Nothing holds, right? But if you're investing, and these things spike, get long because the Fed will always step in. So credit risk up, came back down. That's when Bitcoin really took off. I remember all that. It's been coming down ever since. Scary part is we made a new high from the yen carry trade, tariff risk, had us going up. We don't want to see this, climb like we did back here, right? You don't want to see that because regardless of what you hear in the news, these are real credit investors. These are real creditors pulling back on investing in corporations. Not only just that, investing in corporations, not the stock. You're talking about the debt, right? The debt levels of the stock. You can invest in the debt of a stock. This is not time for that. Talk about that. But the point is that this is confidence. If it goes up, the lack of confidence in the equity market. And it means more people are going into bonds also at the same time, or there's more of a balance in bonds, which, let's not make it tricky. The point is default risk goes up. So we need this to stop going up. It came down. Now it's starting to creep up again. What caused it to creep up again? Let's see. What did we have lately? We had jobs report. The ADP private payrolls was weak. But I think this comes down after today. After today, it should come back down, right? So we need more time. We need time spent, credit risk coming back down, okay? Now, over to the fun part. Let's talk about liquidity, okay? Because I still think, and I'm still new at this. I'm not the smartest guy in the room, but I still think this is the most important factor for markets, at least. The economy is irrelevant. The economy can stay slow and markets go up. Just like 2020, you had an economy that was in recession and it sucked for a while. Markets went to the moon because markets react right away. They're looking at the future. So number one, matter of fact, let me go to another chart. I don't need to use that one. We're going to use Bitcoin for this one. Okay. We're going to switch over to Bitcoin, crypto. Am I missing anything? BTC USD. See how many people fall off on this one. Now, this is very bullish for Bitcoin. Okay. Bitcoin looks great, but what I'm going to do is hide Bitcoin. Oh, these really 3 dots really don't want to work on me, huh? Because I'm live. That's some bullshit. Stupid. Okay. It's all right. I'm going to add the liquidity on here. And if you're on TradingView, just type in Fed net liquidity. Okay. That's going to show you the Fed. But should we start with Fed net liquidity? No, let's do this. Let's start with, let's just start with global liquidity. Okay. Let's start with the global money supply. Some of you have already seen this, I'm sure. Okay, I got all these technical indicators. Let me throw that off. So liquidity is important. Now, this isn't literally liquidity injections, but what this represents is, let me go to the daily. This represents the aftermath, or after credit is ran up, after central banks either print money or governments. Now, this is globally. So we're talking Europe, Japan, China, US, whatever it is. This is the total supply of money, right? Cash in the fiat system, rising or falling over a given period of time, just like a chart. It is making new highs. Why is that? Because, like I always say, keep this in the back of your head, slowing economies is the trigger for liquidity or for money printing, whether it's fiscal or monetary, which I explained in the course. Go check it out for $10.99 a month. No, I'm just kidding. Monetary liquidity, right? So this is total money supply. It is still growing. And if we throw on the month over month, okay, this shows you, let me put it up here. This shows you the impulse of it, right? So you can see when it slows. I hope I make this visually appeasing. If it's not, it kind of sucks, right? You got Bitcoin at the bottom here, but you can see these impulses, right? Money supply peaks, and then it slows down, and they go hand in hand. Like, here was the recession 2022. You had less money in the system. There was less liquidity. There was not a whole lot of investment. Bonds didn't even go up. It was really trash. The only thing that went up was a dollar because everybody's going into cash, right? But there was a lack of money growth. Money growth is sort of like, you know, no matter how good your car is, no matter how good, stick with the car. No matter how good your car is, if you have no oil, no liquidity, your car can't run. It needs more oil. Now, maybe that's not the best analogy. Maybe it's more like fuel, gasoline, right? You have a beautiful car, it's fast, but without the gasoline, it doesn't go anywhere. So, unless you roll it downhill. So there was no gasoline, market couldn't go up. As soon as liquidity boom, you see it goes to the bottom here, the year over year. This is the rate of change of liquidity. It goes negative and then it pops. It goes negative, pops, negative, pops, right? So we can see the overall, new highs, and then we can see the liquidity exchange. Now the year over year is probably going to slow here. Unless the Fed cuts. I don't know. It's impossible to predict, but you can see the impulses up. Now you're getting money supply go up. So liquidity is important because it reflects the amount of financing deals. It reflects the amount of cash out there. Now, maybe it's not in your hands or my hands, but there is money out there in the global economy, in Europe, in China, whatever it is. And US stocks don't absorb all the money, but Bitcoin does. Bitcoin is a monetary inflation hedge. It's not a consumer inflation hedge. If your eggs go up, you don't buy more Bitcoin. But if your credit goes up, right? If you look in your bank's like, we're going to extend 50, we're going to give you 2 times the credit. You're like, let me go buy some Bitcoin, right? Especially if it's down. Now, maybe you don't say that, but hedge funds, banks, they dip into Bitcoin. Look at BlackRock going crazy. Why? Because excess cash is always going to get, cash gets debased, and you need an inflation hedge. Well, here's the sensitivity with companies. Companies still have to have hard, Tesla has hard assets, cars, right? Those things can get destroyed. So there's a lot of risk with a company, even if liquidity is going up. Do we invest more in my business? Because then I have all this extra inventory that can get destroyed or have loans on it. It's expensive to hold shit. Bitcoin is zero expensive. How much does it cost you to hold Bitcoin? Nothing. How much does it cost you to hold gold? Well, you have to get a vault. You have to build security around it. The security of Bitcoin is already built in, and it's digital. Therefore, if you haven't done the work, you're like, what? But if you've done the work, like BlackRock, like Michael Saylor, right? You understand that Bitcoin is the only monetary asset with an extreme level of security, cybersecurity, physical security, right? Stupidity, no, you can lose your keys, but that absorbs money flow. So the more money, the more credit created, you want more Bitcoin because it can't get debased. It is rare, it is scarce. Therefore, even if the economy slows, that's going to hurt earnings on companies, but it causes liquidity to rise. We can see the money supply going up. Look at Europe. As soon as the tariff war started, they started cutting rates like crazy. China, been cutting rates, been releasing liquidity, which we're going to go to the global central banks liquidity. And no matter what, Bitcoin absorbs it. So does gold. But the problem with gold, and I know gold went up and it's like, hey, congratulations. The problem with gold is young people are not buying gold. How many of you guys are really excited about gold, right? Demographics are everything. not many of you care about gold, but you do want to buy Bitcoin. Now, if you're 60, 70 years old, you probably are like, I'm messing with Bitcoin. I get it. But look at Gen Z. If we look at the future, what are Gen Z? What are even younger than that? What do you think they're going to do? You think those fools are buying gold or investing in gold? No, they're investing in crypto. I don't know if they do Bitcoin, but crypto is the new wave. I'm not going into all that. Okay. Crypto is very bullish. Right now, we're getting deregulation from, Bitcoin strategic reserve. I just want to show you liquidity. Bitcoin will absorb it the most. And then it's going to go into alts, which I'm excited for. I've been waiting too long. So you have that liquidity. That's just M2. Now, if we go to central bank liquidity, and we're going to throw this around. These are global central banks. As a matter of fact, we'll just highlight this. Look at this liquidity. This was COVID, right? Economy slow, liquidity rises. What is this? These are central banks buying back their own debt from their treasury, injecting liquidity. They're literally saying, oh, we have a money printer. We can print money. Let's print the money. Let's inject it into the bond market. They're buying treasuries or they're buying bonds, debt. They're buying the debt, injecting cash into banks. Banks turn around, lend more, finance more, or invest more. Boom, liquidity goes up, everything runs up, right? But it's been draining for a while. Now we can separate this by each country to see how different it is, right? We have the Fed, we have China, we have the Bank of Japan. So what we're going to do, just to get you familiar with the process so you kind of have more context, this is China. Okay, China central bank printing. You see it, you see the trend, it's going up. Okay, take that off. Let's look at the ECB. Okay, they can print more. They're starting to turn up because they're cutting rates. They're at the beginning of their liquidity cycle, but they're cutting, because when you cut rates, you also inject liquidity. They're moving up. Look at Japan. Well, Japan looks like trash. Japan actually has high inflation, so doesn't really help our narrative, right? Sucks, but because we want Bitcoin to go up, but it's okay. Bank of England. Okay, so this is the Bank of England. Liquidity is kind of down. They're still falling, right? Now, if we include the rest of the world, okay, it's breaking out. It's breaking out. So I'm separating it so you have more context here. Brazil, India, whoever it is, they are printing. The liquidity cycle starting to pick up. And if we look at the Fed, it's a balance sheet. It's starting to flatten out, though. Starting to flatten out. So we're at the early stages. We still have 12 months. And I said this 4 months ago, but I didn't know we're gonna have a freaking trade war, okay, and tariff war. Couldn't guess it. And now that we know this, we need Trump to make visibility on the deal, okay? We need to get tariff prices clear cut and reduced, just minimize them, so the Fed can have room to communicate to the market. We can cut now, okay? Because it is slowing. It is slowing. People are defaulting. They're going to need, Trump is draining. I don't want to say he's draining the economy, but, student loans, if you have student loans, you're going to pay more, right? He's doing things that are long-term good, but short-term pain. So when you add them all together, let's put all the central banks on there. What do we have? We have a cycle. Well, actually, let's take off the Fed. I know I'm probably going too long on this, but let's take off the Fed because we know they're at zero. We're starting to move up. We haven't broken out yet, but once this goes up, Bitcoin, you think Bitcoin's up a lot now, dude, it has a long way to go. It is feeding off of this money printing. And Americans are not the smartest. If you're American, good luck. But you think Japanese, those dudes are buying Bitcoin and they're trying to get really risky. Japan is very risky at the end of the day, right? So here's your global liquidity picture. Here's Bitcoin. You can see it go up and up, blah, blah, blah. Money supply is the end product. This is the beginning product. And then if we look at just the Fed, you can see that now money supply is going up. I'm always looking at this stuff. It takes time. You got to be patient. But now we're going to look at the Federal Reserve's net liquidity indicator, right, which came back down. And this is literally how much their balance sheet plus the Treasury General account, which we can look at, plus, and that's Trump spending money, plus the reverse repo. Okay. Now I'm getting nerdy here. This is all teaches you all this stuff inside of the course. That's going to be cheap. Okay. RRP. Okay. This thing is gone. Maybe you heard of it. Oh, that's not the RRP. Okay. We're not going to go to that. It's going to take too long and too confusing. I do want to look at the TGA though. Okay. This is really key for markets. Treasury General account. This is basically the cash at the, Here we go. Treasury General. This is the cash that's at the U.S. Treasury. Okay. So now that we have taxes that went through, now that taxes have went through, they are flush with cash. This is why I said I really thought April, and if you guys are new here, I'm going to show you, I really thought April would be the lows. Now it was a lot more painful than I initially thought it would be. Hold on, I'm looking for something. Okay, it was a lot more painful than I thought it was going to be, but I want to show you something. See if I can find the post. I'll be looking for it. Yeah, we'll find it. So this is a Treasury General account. When it goes up, you're basically seeing the Treasuries pulling money out of the market. They're causing banks to basically, this is how much cash is going into the Treasury. But when it comes down, right? For example, COVID, it went up, it got full. And then when it unleashes, it's unleashing liquidity into the economy. It's the Treasury, basically Trump Besant, now spending, creating bills, right? And what are they trying to pass right now? They're trying to pass a huge tax cut. So when this thing leaks down to the lows, you're getting an injection into the economy. The bump higher was them paying. This is why the rates have to come down. The bump higher, when it goes up, that's also them losing cash. Or I'm sorry, not losing cash. That's also them. No, it is them losing cash. They are, damn, I'm getting confused here. Sorry. I'm trying to think inversely. When it comes down, they're printing into the economy and they're paying the bondholders. They're paying the debt holders. So when it goes up, they're losing cash. That's why the Federal Reserve's FedNet liquidity went down, because this thing bumped up 1-for-1, meaning you really want to see that when this thing starts to roll over, you're going to get injections into the economy. So it probably goes down to near zero. I don't even know where the measurement's at right now. Here it is. Here's zero right here. It probably goes near zero, just like it did in May of 2023 or June in the summertime, because that's when you create the most bills, the fiscal bills. We're going to get tax cuts. We're going to get Bitcoin strategic reserve. You know, that's Bitcoin. You're going to get all these different stimulus bills, right? There's probably, who knows where they are. They want them. You want them to get passed if you're bullish. So as this rolls over, more liquidity is coming into the market. Now, right now it went up, less liquidity, but trust me, it is going lower. They are spending. Why? Because number one, what happened to all of you? You had to pay taxes. So that removed liquidity from the market, from the economy, because you're not spending more when you have to pay more taxes, or when you have to pay taxes, right? That's why I think the lows were going to be in April, because not only was the trade war picking up, but people are going to get scared. They're not going to buy more stocks, but that's over with. And the Treasury had no money to spend. Now the Treasury is flushed with cash. They are at, okay, the top here is 800 billion. Right now they're at 617 billion. So they collected more. Oh, okay. Now I know what it was. Okay. Stupid. All right. My bad. This is what it was. And this will make more sense. Let me turn it into a different chart. Work with me here. That thing, column suck. Area. Okay. Here we go. This was tax collections. So the count went up because they just collected a bunch of taxes. So this is good because it's not random. It's not them. Well, it is them sucking cash out of the system, literally, right? This is cash moving out of the system. You pay taxes. Boom, here comes the tax bills. Here it comes back to the lows. Then FedNet liquidity will go up. Global liquidity will go up. Markets go up again. So I really think July, August is going to be a hot market if the trade deal gets done, because liquidity is set to ramp up. And when I said, hey, I thought, this is going to be my pitch to you guys, is keep up with what I'm doing, because I did warn to my audience that the lows would be in April. Let's go back. Okay. Yes, I am. I'm trying to sell you on my course. Sell you on my newsletter or my personal notes, but guess what? It's free. So it doesn't matter. It's free. So April lows, where is it? April will be the lows. I know I put it on here, and I'm going to show you why I did that. This is my attempt on marketing. April bounce. Okay, maybe this is it. April bounce. Oh, the conditions for an April low. This was written March 30th. So this was in March, and I was like, look, can't get much worse. This is a AI sentiment indicator. Can't get much worse, and it did. Who the hell's calling me? Oh. Fear and greed at the bottom. right? And we're going to take a look at this. This is the exposure index, so how many fund managers are where they're positioned. Advanced decline was actually showing bullish divergence. Anchored VWAP. Bro, this is literally what I showed you guys earlier. This is where the market bounced. Okay, I lied. That was a different one. Anchored VWAP from, we went straight through that. It was the anchored VWAP from the 2022 lows. Okay. So April was the low, but it was lower than I thought it would be. Okay. It was lower than I thought it'd be. Anyways, I'm really just marketing my newsletter. It's free. Link in the description. I don't know where you guys are at, but go check it out. Throw me so I can throw some content, some new stuff at you guys in the future. I'm going to make some packages, right? Go check out the newsletter. Anyways, we'll get back to the market. I like to throw my thoughts in there. Not like a newsletter. It's more of like, if you want to know what I'm thinking and I don't make a video because it takes time or whatever, right? Let's go back to the chart though. And I throw charts in there. Okay, let's go to, yeah, here we go. No, there we go. All right, so Bitcoin. So let's do a little bit of technicals on Bitcoin. We're almost there. But before we hit Bitcoin, because of course I want to hit Bitcoin, but I got to go through this. Why do I have to do this? So you guys understand what I'm presenting for you, the type of content. Okay. The number of stocks, right? This is bullish. The number of stocks trading above the 50-day moving average is now above 50%. Okay. We're at, what are we at? 50. You see this impulse though? This is market breadth. Now let me just calm it down a little bit. This is important because you have the technicals, but then you have the underlying strength. How many stocks are participating? For example, if you run a business and you have a potential 1,000 customers, let's say 100, and most of your revenue is coming from 2% of the customers, well, if they leave, your business falters, right? So the more you get diversity of customers, the more strong or stable your business is. The stock market works the same way. The more stocks that are participating, and there's different ways to measure that, the more healthy the recovery really is. It's not just, as a matter of fact, Apple trading like trash right now on Amazon and the market goes up, that's super bullish because that means, investors, whoever, retail, whoever it is, they're buying the trash that got rolled over. Check out Elf Beauty, which I do want to, there's so many things I want to look at. Elf Beauty expanding, right? Going up. Although, it's a China stock, that thing's probably going to rip. I got calls into 2027, right? Debit spreads, because I think it goes back to 200. It's at like 65. Now, I'm not really big sized into it because Trump could change his mind, but I want to see how it plays out. I want to learn a little bit. And this is way out into the future. So anyways, the amount of stocks, and there's really two metrics doing well here, okay? The amount of stocks trading above the 50-day moving average, market breadth, starting to expand here. The amount of stocks above the 20-day, this is even more bullish. Well, I don't want to say more bullish, but different. This is another measurement of breadth, or, not breadth. Let's use a different word. Basically, it measures the bull, how do I say this? It measures how wide the bull market is, right? The percentage of stocks moving up, percentage of stocks actually moving up, right? So above their 20-day moving average. So if you go back 20 days, which is about a month, I think somewhere around a month, stocks are now above their monthly trend, right? Their monthly moving trend. So how many do you got? 89, bro. 89. This is percent terms. You can only go to 100. 89% of stocks recovering above the last month. Is it really month? 20 days, whatever. I mean, we're talking trading days. So I'd say 5, 10, 50. Yeah, about a month. So the last month of price action. Well, what was last month? It was the worst freaking month in who knows how many years, right? So you're getting 90% of stocks, trading above an average in a shitty month. That tells you we are recovering. 50-day, yes. Now here's the key one though, to really know if we're back. We need this to really pick up, and we're getting there. Look at that breadth, okay? Look at the wideness, percentage of stocks above the 200 daily moving average, because you could be up in the last 20 days, but still be so deep and, so drawn down that you're still behind. So once you get this cross above 50, it's game over. We're not there yet. We're at 41, but we are gaining, and we got deeper than we were October 2023. I don't know if everybody remembers that, but that was a big drawdown. Not as bad as a pandemic, but once you get above 50, and I marked it, once you head above 50, that's pretty much it. You've recovered. The bull market is back. You can pretty much buy closing your eyes, unless Trump does something stupid, which is why we track the macro, right? But if we make a new high above 46, 47, then we're back into the bull market, right? So market breadth's picking up. It's just bullish. Just want to show you that. Now we can look at the impulse, the amount of stocks, and I signaled this the other day in the newsletter, which was the amount of stocks making new 5-day highs? Yeah, 5-day highs. Boom, exploded right to 300. Why is that significant? Because this has only happened 8 times in the last 2 years. Oops, did that backwards. It's only happened 8 times in the last 2 years. And each one of those times, not every single time, but when the market was oversold, so you were in a, RSI oversold, that was the end. That was the bottom. So the question is, does it follow up with more 5-day highs? And of course it's going to fall down. You're not going to get continuously 5-day highs, new 5-day highs, but it stuck around 100 at least, right? Oh shoot, that was my camera. Okay, it sticks around 144 and it's climbing. It's almost back, bro. This is very bullish. New 5-day highs. Investors are excited. Okay, they're excited. If we move to new 1-month highs, look at that big impulse. We just got that today, as a matter of fact, after the employment report, which is key. Last time we got that was back here January, the bull market, right? And I know that was the end of the trend, right? In January, that was the end of the bull market. But think about it. That was after we were overbought. Now we're oversold. So we're actually lifting. We're in momentum, right? So there is more stocks participating. New 5-day highs, new 1-month highs, new high. These are new highs altogether. That one doesn't look that great. We're far away from new 3-month highs. Actually, we've had the highest 3-month highs since. Nah, don't worry about 3-month highs. That one is not as good of a reading. I don't know why. Maybe I'm biased here. New 52-week highs will be important. I think we need to get above 100, at least 100 stocks making new 52-week highs. So we're in early stage recovery here. Okay. Last metric is risk taking, right? This is how would I explain this? This is the risk appetite. When your appetite for risk is high, it's usually pretty bullish. So we're going to look at the monthly week. Should we do weekly or monthly on this? We'll look at the high beta versus low beta. So this is basically high beta assets. For example, Oklo, right? They don't even have earnings. They're basically high risk assets versus low risk assets like Costco, right? Or Verizon, something with high dividends. When you have the high dividend stuff or the low beta stuff moving higher, that's usually a sign of a defensive tilt, right? The market is turning defensive. But when you have the high beta stuff come up, that's a sign. And the analogy would be, I'm literally making this up on the top of my head. The analogy would be when you go to the store, right? Or you go eat, sometimes you look at that menu and you're like, let me get that value menu, right? Let me not spend too much. But what are the times when you buy the most expensive shit? When you get the steak, the extra sauce, right? When you spend that extra money, it's because your confidence level is up. That's the same thing with high beta, low beta. When the high beta stuff pumps, that tells you investors' confidence is back. They're ready to spend, except for this is not going to disappear. These are their investments. And when more beta, high beta stuff continues to rise, and we just hit that, we're coming back up. Once you get to the highs, or once you start to reaccelerate, which I think we are, then the bull market is back. That's what that means. The bull market is back. Now, if you look at total crypto, this is crypto versus S&P, altcoins versus SPY, not Bitcoin, not Ethereum, alts versus SPY. We are trending higher, right? So this is relative strength, another risk indicator versus S&P. It hasn't broken out yet. It looks good, but it's not, we're not there yet. We probably, hate to say it, need Ethereum to pick up. And I am not your guy to tell you how good Ethereum is doing right now. I know they're trying some new stuff. But look at the trend is up. I'm pissed. You could tell I'm pissed. I'm like, bro, alt should have already broken out. But guess what? Alt season is coming if the Fed is dovish. I'll just tell you that much, because they don't care about business activity. They care that, there's better financial conditions. And it's not that alts care. It's that investors have so much cash, the rich people, bro, they're not thinking about their job. They're just like, where should I throw money, right? If rates come down, boom. If they believe financial conditions are easier, boom, they're buying risk assets. They're buying the future. They're buying altcoins, not Dogecoin. They're buying stuff that actually works, right? Now we have consumer discretionary versus consumer cyclicals, right? For instance, this would be the relative strength of Tesla, Amazon, the boat, what are those stupid, the stuff, cruise lines, right? Stuff that people buy, they have excess cash, not essentials versus essentials. Well, when it came down, people were buying essentials, they're buying defensive stuffs. And I know some of you guys might or may not be in there. You're like, hey, what can I buy as defensives? I threw you out a thing in the charts, right? We went over them, right? For example, see if I could do this smoothly, this transition. Okay. We talked about defensive stuff. Okay. Bear with me. I'm trying to make a move, a YouTube move. See if I can make this move. Where's it at? This is the thing. Long-term compounders, let the dust settle, no man's land. Damn it. Oh, okay. It has a night on it. Flight to safety picks. This is when I said, look, I don't believe we're heading into recession, but I'll go ahead and send it out. Some people are asking for it. Flight to safety stocks. And that's what the defensive stuff is, right? Who did we have here? Here's why I said we're not going to do that, because we're not going to go over that. You can come read this on the website for free, right? Retail sales are still strong. Industrial production is still strong. Unemployment rate still good. PMIs are the weakest thing, but still recovering. Defensive style tilts, right? Who do we have on here? Who is it? I can't even, why can't I think? It's a communication. TMUS. Oh my goodness. You have Verizon. You have, bro, why can I not think of this? Oh, you guys know who it is. Telecommunication, phone services, right? Okay. I can't think of that. Tobacco. I should have put the names on there because now I'm over here. This is tobacco. Philip Morris. There we go. Philip Morris, Clorox, Procter and Gamble. This was a real estate play, right? And it's mostly, I don't even know what it is, but it's good defensive, high dividend. Duke Energy, Southern Company, utilities, basically big pharma, healthcare, whatever, TLT bonds. These are all defensive assets. And my whole point is that that's what people want, or investors and hedge funds go after whenever they believe there's a recession. And you guys already know, duh, because they're scared, right? But I was like, hey, it's too early for that. Sure, there will be a trade, but I don't think it lasts long because it's not structural. It's Trump's how he feels. And he's not going to feel like doing 100% tariffs over time. He's going to be less. So yes, it felt defensive-y. You wanted to get defensive-y, but now that stuff is ripping. For instance, Bitcoin's up. You should have bought more Bitcoin at 78K, not Verizon stock, right? Or utilities. Now, if we were headed for a long three, this is, I want to say it's my expertise, even though I'm not the best trader, understanding where we are in the cycle, which is don't buy defensive shit because we're not headed for a full-on recession. If it was, because it's based off of Trump, he's not going, and the Fed has cuts. They have room to cut, and the ISM is still picking up. We're not the end of the cycle. We're not in macro fall. We're in macro winter, meaning we're ready to turn up as soon as the Fed cuts and ISM goes up. Okay, for short, we're at the beginning, not at the end, right? And so everybody bought defensives, and hey, maybe they're right. Maybe we have maybe we go into a deep, long recession. But guess what? We're doing a deal with China soon. We're doing a deal with India. The panic is over. So cyclicals are starting to rise. Okay. I know that was a lot to just say, hey, IPOs also. You look at IPO index, which I'm not a fan of. I know a lot of people like IPOs. The best IPO of all time is probably Palantir. Okay. Worst pain of my life. Messed up on that one. But IPO index looks like trash, starting to rise, right? That's because people are getting riskier. And then for the micro caps, those companies that are under 30, literally under 30 million, these things boom. When they boom, they boom. OPTT, still waiting for that one to come back. Cooler Technologies. We saw that run up from freaking 30 cents to $5, right? I'm not saying do it. I'm just saying when micro caps versus, and this is micro caps relative to small caps. So small caps are small, right? You got mega caps, large caps, mid caps, micro caps, small caps, and then you have micro. Okay, these are very small. When these start to break out, and maybe I should turn this into a chart, that's how you know it's bull time. Bro, what the oh, okay. Did the wrong one. That's how you know it's bull time, when the micro caps pull out, right? Are we there yet? Almost. So micro caps relative to small caps went to the almost all-time low, right? And now they're pumping. No, I'm just kidding. They're not pumping yet. You still need some, see, there's no RSI on there, but you still need some time. Point is, the risk is back. Now let's move to Bitcoin. Okay. This is taking longer than I thought, but guess what? I'm going to deliver you, like a podcast style. So here's my indicators for Bitcoin. Number one, global liquidity. If we really dive into it, M2 has led Bitcoin. Damn, this chart sucks for how I want to show it. And I've done, I showed this on, this is in the newsletter, free newsletter too. I know nobody cares about newsletters, but I need to practice on getting people there. All right. So you can see that M2 usually goes with crypto. Look at this. It leads Bitcoin by about 60 to 90 days. Okay. And I did this in ChatGPT. And I measured it myself. 60 to 90 days. Has it peaked? I don't know. But Bitcoin, okay, peaked here. And I'm sorry. M2 peaked around January. It took about 70 days. And I have a chart somewhere on Twitter. It took about 70 days to peak. And then it took, should I just show it? You know what? Some of you guys are probably already on Twitter, huh? How many of you guys, as a matter of fact, can you guys throw on the comments where you're from? I can't tell. I'm on StreamYard. I would appreciate it. So you can help me out as a content creator. Let me know where you're coming from. If you're YouTube, if you're Twitter or YouTube or X, sorry, X or YouTube. Let me know really quick while I go pull this chart up. Just throw it in there. Just put a Y. You don't have to say the whole thing. Y for YouTube, X for X. All right, here we go. Here it is right here. Okay. So 90-day lead for this one, meaning M2. Okay, so we got YouTube nice spotlight reviews. Welcome. This took about 90 days. It peaked. Bitcoin peaked 90 days later. Okay, peaked 70 days. Now I'm thinking 90. The average is between 60 and 90. So I'm thinking 90 days would bring us to July or August. That's all I wanted to show, which is there's this lead time for M2. Why? Because it takes time for money to be printed, and for it to get to the asset is going to take another who knows how many days. Doesn't mean it's perfect, just gives you a model to understand. Okay, it's just a model. Now back to the chart so I can show you the actual technicals here. I need to get so much quicker at this. Not so podcast. All right, so let's take M2 off now. I don't care. Now let's throw on Bollinger Bands, right? Let's throw on Bollinger Bands. This was also in the monthly news or the weekly newsletter, log style. Yeah, no, log style. Keep it log. Okay. Oh, okay, log style. So here's what I've seen. There's two measurements here: the slingshot and the crossover, right? And the moving average crossover. So if we look at Bitcoin, once it bottoms, we're going to go all the way back to 2024. This happened in early 2024. Okay. Once you had this consolidation, this was the banking crisis. So boom, 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 banking white liquidity, Fed prints goes up. If something breaks, the Fed prints. Okay. Hopefully it's a bank, not a business. Hopefully it's a bank, because if a bank breaks, that's easy. You solve it by injecting money, right? There's no other recourse. Bitcoin goes up, but it started to consolidate for about 90 days, 3 months. And here's what you know, once you get a bottom, so you have this double bottom here. Okay. The Bollinger Band, you want to see Bitcoin jump to above the midpoint of the Bollinger Band. It jumps above the midpoint. The blue line's the midpoint. It holds it. It presses against the upper band, comes back down, holds it, presses against the upper band. And I'm kind of walking through it. But the point is, once it bottoms and it presses against the upper band twice, here's one. Okay. Because here it did it once and then it kind of did it twice. So I guess that technically was true, but it wasn't a big move. You see how this one was lower? Once it makes another high. So you got a high and then it presses again, makes a new high. It's gone, right? Retest the previous high. And then it breaks out 50%. That's what I got. 50% breakout after that. Check it out. Did it again here. Consolidates, right? This was the end of 2024. You had it under the Bollinger Band. It bottomed. And you don't ever know when the real bottom is. but you can tell by the macro, right? Is the Fed switching, right? Can you tell? I don't know. That's why you need to keep up. I don't say you need to, but you'll know more if you keep up with my newsletter. I'm going to tell you when it's starting to get bullish, when the conditions are now favoring risk, right? Gets above the Bollinger Band, holds, presses, and this was a long press. It just broke out. So it just pressed. But once it gets above the midpoint presses, it's gone. There's a couple ways to do this, right? So look at today. Here we are to, oh wait, no, this was the last one. Maybe there's 3. All right. Here's the other one. Presses against, okay, bottoms out. We get the double bottom. I remember this. You kind of have this reverse head and shoulders, right? And then you get this press above the Bollinger Band, holds, and then you get one press. The second press is bigger than the last press. When I say press, just impulse, right? So the second impulse is bigger. And these are not perfect, okay? I'm just thinking you need to consolidate under the midpoint, break above it, and then press twice. 1, 2. Yes, it came back down, but the 1, 2 counted because it broke out, okay? Broke out, pressed against it. Now we're getting that today. Same thing, right? We had a bottom. This is the bottom, bro. This was the freaking panic, Trump panic, right? Gets above the midpoint of the Bollinger Band. We actually consolidated, which was healthy, pressed hard, and here we are for the second press. Now we can pull back, support the midpoint. What's going to get us to pull back? The Fed is not dovish. The Fed's hawkish, right? That's going to pull us back. Bitcoin cares about liquidity, does not care that earnings were lower. Doesn't give a shit about earnings. It doesn't matter. It cares about liquidity, right? Because liquidity leads earnings at the end of the day. The more money you put in, the more it converts into earnings at some point. So we get that second press, which we're headed there. We're not there yet, right? Once we touch that, that's gone. I think it's 100K. Now, it does seem like, oh, I don't want to buy at 100K. I'm not telling you when to buy. I'm telling you the momentum, the slingshot has been released, right? The rock is coming back, boom. It releases once you hit 100K. That's it. Somebody's gonna get short, not short. They're gonna cover. FOMO kicks in, and more than likely the Fed is dovish. More than likely Trump has made a deal. So once you hit that second level, it's gone. Now that is kind of a rough estimate of using Bollinger Bands. That's a rough way of saying it. You need to consolidate under the midpoint, get above the midpoint, and press the upper point twice, and then you break out. Now, the other way is to look at the weekly chart. Okay, this one's a little different, and this one's way simpler, right? You basically have, why does it look like you basically have more oh, this is way back. Now we're doing this cycle because price action, it changes every freaking cycle. You know, the more you dial in, you have a consolidation underneath the midpoint, same thing, right? Gets above it. Now this one just presses for at least what, a couple weeks, 1, 2, 3 weeks. Presses, gone, right? Consolidates under the midpoint, gets above it, presses the upper point. So at this point on the weekly, it might be simpler. You really want to see consolidation under the midpoint and a break above. Now we have to close above strong. We have to get to this top band, meaning 106K. So this one is less. This one's not, it's a slower trigger, but you know for sure, right? You have to get 106K. Well, duh, by then you kind of know you're breaking out. So here's my other way of measuring Bitcoin, and every cycle changes. This, you know, every cycle is a little different. This one I used anchored VWAP, right? So check this out. We're going to take the Bollinger Bands off. You're using anchored VWAP from the high. Here's the high. Oh yeah, I got it right on there. Oh, okay, still there. Okay, so this is still on here, right? Anchored VWAP from the high. I'll go ahead and take this off, the trend stuff, and you're using the 12-week EMA. See if I have it. 12-week EMA. Yep, 12-week EMA. Why now? Why am I using 12 weeks? Because that's the one that worked, right? People like to use one moving average, one simple. The truth is, every asset has a different signal with the moving average. You got to move them around to kind of see which one is working best. For instance, okay, I take the anchored VWAP from the high, meaning volume weighted average from the high. So as it falls, that means you need to get above it to really break out. Breaking above the average weighted volume, breaking above anchored VWAP is a break above the high in terms of volume. Think of it that way. Usually you make a new high. Well, you're making a new high in terms of volume, which is really what moves price, not necessarily a candlestick, but the amount of volume, right? So once that's why I use anchored VWAP from the high, because I want to measure from the top. Now, when you get the 12-week EMA cross above it, boom, you're gone, right? At least for 2024, it happened every time. And I tried the 24 EMA, all the other ones, it didn't work. It had to be the 12. Once you get the 12, it's gone, right? Same thing here. See how I didn't get above it? I don't even know if you guys can see that. Let me zoom in, right? Couldn't get above, right? Resistance. And then once it crossed, Bitcoin was gone. Now look at us now. We're not there yet. That's why I'm like, hey, still cautious. We could retest that Bollinger Band. We could come back and retest, right? Anchored VWAP like it did. Boom, retest. Or actually, no, it didn't retest. We're pretty bullish because we're above it from the high. That's the crazy thing. We're above it. So I think I would say 70% chance we're breaking out from here. We get a small pullback, right? But once it crosses, according to the history, we're gone. And I think we have to get to 100K for that cross to happen. Now, this is why 100K is important. If it hits 100K, you're going to get a nasty pullback. That's where you enter. You enter on the pullback, right? And you're probably already in it, but it's just where you get more bullish. You enter on the pullback, not necessarily the impulse higher. And then it's going to retest all-time highs. And if you measure it out, you're at 150K. Okay. So that's Bitcoin. Yes, Chainlink. I'm still very bullish on Chainlink. A lot of good news on here. I haven't figured out how to communicate it clearly. This is my biggest position still, other than Tesla. So yeah, Chainlink's still a big position. Eric Trump's talking about, listen, nothing works without this. This is the underlying technology. It might take longer because it is so new, but the financial system, look at Sergey Nazarov, they have to use a universal connector to connect the US financial system and the global financial system into the blockchain ecosystem. You need a universal connector. That is Chainlink's technology. Okay. That's all I can say right now. This thing is monstrous. I'm just waiting for it to get above 1530. Actually, I don't know. It's breaking out. It is technically breaking out. I'm just like, oh, should I add more? Or should I wait? Or should I just get long Tesla? And I am long Tesla. Okay. I have a couple I have some leap calls. I got some shares. I was heavy in shares, but I had to pull back a little bit because I don't want to take a drawdown. Okay. I can't afford to take a drawdown right now. I just can't. April really hurt me a little bit. Okay. April hurt me with some options. Still pissed at Trump, but it's okay. That's how it goes. Can't blame anybody but yourself. All right. So here we go. Tesla, on the other hand, try to break out. Tesla needs to get above 295. 295 is the level. You want to see it close. I have a feeling that it might gap up. It might gap up on Monday and then pull back. You just never know. You need to see the volume increase with Tesla. When you use this volume indicator, this is like it's volume levels. It keeps peaking above it because once that volume shelf, this is a volume shelf. When you get above it, it's like open season. Nothing's there, right? 310 to 320, there's nothing there. Just eats it up. And it probably slows into about 350, right? 330 to 350. So I think once Tesla breaks out, and it's so much narrative, okay? Tesla is so much narrative. I'm going to stop here and break down a couple things on Tesla. We've went through breadth. We went through the trade deals. We went through what gets the Fed dovish or what you want to hear. Okay, earnings growth, revisions. So you have price technicals. We talked about price. We talked about the environment, right? What's the environment look like? Well, inflation is falling. That's good. Oil prices are falling. That's good. Interest rates are easing. That's good. Everything looks good. You just need the damn trade deal, right? That's why this is so nerve-wracking because you cannot predict what Trump does, okay? But he's going to be forced to make a deal. Okay, so price, environment, and next is going to be the potential. So who has the most potential? Now you can go get, all these other stocks. You can do whatever you want, but I still think, the most potential in a couple assets is going to be between AI, Palantir, and it's already breaking out. We can already see that. Tesla, which is physical AI. Nobody else really has physical robots, and those won't come online for a while. Let's take this off. And then look at Tesla's MACD. This is a momentum indicator. It is crossing above the midpoint. It is accelerating. RSI picking up. It's accelerating. It looks really good. Okay, it looks really good. And then if you really take a step back and you look at the long-term trend, okay? And when I say long-term trend, I'm talking, let's go to the monthly chart. I'm speaking of the shift in momentum from the pullback. Maybe we'll go weekly. That might be a little too far back. Okay. So the shift in momentum, you can see that it's in an uptrend, right? After that big blow off top in 2021, it was up too much for the fundamentals. Okay. It went up way too much. Yes, Model Y is still the top selling EV in the world. Not this top selling car it was in 2023 and 2024. Energy storage is 11 billion annual revenue. That's huge because you need more energy for all of AI, for data centers, etc. They are powering data centers. You just don't know it yet. Their manufacturing facilities are the next generation for manufacturing. They're literally robots manufacturing. Forget people, right? This is why they don't care to have too much immigration, because robots will take over, and that's a lot more revenues, right? Number 3, the car business is slowing because it has a lot more competition and because automobiles are tough. So it's all about taxis, right? Robo taxis in Austin coming up soon. Number 3, it's also the most powerful one is the autonomous robots, which we won't see till 2030, but it will get priced in early. It's going to get priced in early. Okay. In 2019, they priced in Model Y, and Model Y didn't come out for a while, right? Cybertruck didn't come out for a while. I remember that. So, and that's different, obviously. All right. Autonomous robots are different, but the potential will get priced in. Tesla is a meme stock, meaning it runs off of sentiment. So it takes one good story after being beaten up for so long for Tesla to explode. Gets to the top of that level, maybe gets to 650, comes back down. It can come back down to 380. Who knows, right? By then, hopefully it holds all-time highs. Or it can just go super mode and break out of this trend and go to 1,000, right? It can do that, but that would need massive regulation. It would need the cars to actually work. It would need the network to come on. It would need a lot of stuff for that. I can't predict that. All I know is Tesla's a huge opportunity. Bitcoin is easy. Bitcoin, you got to have Bitcoin. Palantir, wait for the pullback by a little bit at a time. Don't get too heavy. It's already up too much. Chainlink, I mean, if you can go 5 years out, that thing is going to rip because it is the center of the financial system, right? Not pinpoint. I'm not trying to be too exaggerative, but it is the center of the new system as far as I can see, right? Not XRP, not all these other things. It's going to be Chainlink. Swift is using them. I mean, there's so much news on it. It's just really nerdy, geeky news. So you just watch price. Once you get over 15, you have 17, and then it's gone. It's going back to 30. It's been an hour and 48 minutes. I hope I gave you guys a good show here. I want to do these on Fridays to do a review of kind of what's going on in the market, how I'm thinking through things. And if you have questions, then, throw me your questions, whatever it is. I ask you, don't forget to like, subscribe, please. Like and subscribe. Help me out with the algorithm. Been doing this for a couple years, and it's rough. I don't know if I'm going to do edited videos. They take way too long, and I don't get enough information out there. So I want to do more of these streams to catch people up from what I'm seeing with the economy, right? With the environment, which is the economy, the macro, what the Fed's doing, fiscal policies, all that. And then price, the technicals, and then what is the potential? You also have, like I said, OCLO, SMR. You have all these other things, but I don't want to talk about that yet. I think we're kind of early for that. But once we get a rip higher in pure risk assets, we're going to get a pullback. And I think that's when we'll start talking about these futuristic innovation stocks, right? And assets in general. But other than that, I think I'm gonna stop it there. I appreciate you guys joining. You guys have a good weekend. Stay blessed. Eat healthy. Work out. Try to be the best you can be. Do not give up whatever you're doing. Okay. Don't give up. You might have to, adjust things. Don't give up. And think of something outside of yourself. Focus on something that's bigger than yourself, so you don't get too frustrated with markets. Other than that, I'm out. You guys stay blessed. I appreciate you guys, and I'll catch you next time. I'm out. See if I have an exit. Try my exit thing real quick. Outro.